Welcome back to Intelligent Investment Today, the podcast concerned with all things value investment. In each episode, we take a different topic from the investment landscape and attempt to apply the lessons as laid down by the man widely considered to be the father of the craft, tutor and mentor to superstar investor Warren Buffett no less. We're of course talking about Benjamin Graham. In today's episode, we're going to be considering something a little bit different, what has been called the marshmallow test. On the surface, it's a psychological experiment about children, patience and treats. But if we scratch just a little deeper, we also find it has some fascinating lessons for investors. Specifically, it forces us to ask, how do we deal with instant gratification versus long-term reward? Do we have the temperament to delay, to wait, to let compounding do its work? And perhaps the bigger question still, is that temperament innate or can it be learned and developed? So without further ado, let's get right down to it. As ever, sit back, strap in, and get ready to take on board another lesson in value investment as inspired by Benjamin Graham. The famous Stanford marshmallow experiment was carried out in the early 1970s by psychologist Walter Mischel. It wasn't really about marshmallows per se, they were simply the bait. The study examined delayed gratification, the ability to resist an immediate temptation, in favour of a greater reward further down the line. Here's how it worked. A child, usually between the ages of 4 and 6, was seated at a small desk in a room. In front of them sat a marshmallow, or sometimes another treat of their choosing. The researcher explained that the child could eat the marshmallow right away if they wanted. But, and here's the kicker, if they could hold off for 15 minutes without eating it, they would be rewarded with 2 marshmallows. Then the researcher left the room. The child was on their own, faced with the ultimate test of patience. The results were both hilarious and fascinating. Some children caved almost immediately, gobbling the marshmallow within seconds. Others squirmed in their seats, poked and prodded the treat, sniffed it and even licked it, but eventually gave in. A smaller group managed to hold out for the full 15 minutes. What separated the successful from the unsuccessful wasn't brute willpower alone, but strategy. Some distracted themselves by playing with toys in the room, some covered their eyes, others sang little songs, and one particularly inventive child even curled up and fell asleep. That child, I think, had the smartest approach of all. So did the test prove anything exactly? The researchers originally hypothesised that those who could delay gratification would go on to achieve better life outcomes, higher academic success, stronger careers, even better health. And later follow-up studies suggested there was indeed some correlation, though not as strong as initially thought. Critics rightly pointed out that the test may have been measuring something else entirely, not just self-control, but trust. If you were a child from a home where promises were frequently broken, why on earth would you trust a stranger in a lab coat to come back with a second marshmallow as promised? In that light, eating the first marshmallow might not be impatience, it might actually be rational. So the marshmallow test doesn't give us a neat answer about destiny, but what it does do is give us a vivid metaphor for the tension between instant gratification and long-term reward, a tension that every investor must also grapple with. If we move from 4-year-olds in a Stanford lab to adults in the real world, the parallels are everywhere. Look around and you'll see marshmallow tests being failed every day. Take cars for instance. The number of people I know in their early 20s are driving around in brand new £50,000 cars that they can ill afford is staggering. They're paying out huge chunks of their income on finance deals just to have a flashy set of wheels. By contrast, my first car was a battered old Citroën AX, more rust than metal, and I didn't buy a new car until I was well into my 30s. Yet today, the idea of waiting even a few years to upgrade seems absurd to many young drivers, and the consequences are clear. In the UK, over a quarter of people aged between 25 and 29 still live with their parents. Yes, part of that is due to surging house prices, but spending thousands on cars you don't need isn't exactly helping them onto the property ladder. As Keith Richards once said, some folks never kept a dollar past sunset. That to me is the adult version of the marshmallow test, and it's a test many seem destined to fail. And nowhere is this more apparent than in the stock market. Time and time again, investors fall prey to the lure of instant gratification. There's a reason get-rich-quick schemes are so popular. There's a reason YouTube is filled with self-proclaimed gurus promising rapid gains, trading hacks and miracle strategies. They're selling the financial equivalent of that marshmallow on the table. Quick, easy, available now. But true wealth building doesn't look like that. Real investing, the kind Benjamin Graham taught and Warren Buffett perfected, is the art of waiting. It's about buying something undervalued, having the patience to hold on to it, and letting compounding do its quiet, magical work. And yet, most people can't bear it. If their stock doesn't double in a year, they jump ship. They chase the next hot tip, the next new strategy, the next guru with promises of fast results. They are, in effect, the kids who just couldn't wait 15 minutes. This brings us to the crucial question. Is patience innate or can it be learned? Are you either born with the temperament of a value investor or doomed to forever grab the marshmallow the second it's placed before you? The truth, as usual, lies somewhere in between. Some people do have a natural disposition towards patience, just as some children in the experiment had no trouble ignoring the marshmallow. For these people, value investing comes more easily. But to say patience can't be learned would be too pessimistic. Humans have an extraordinary capacity for self-discipline when they believe in the goal. We've seen people quit lifelong addictions, rebuild their health, and retrain their habits. If someone can give up smoking after 20 years, surely it's possible to learn the art of sitting on one's hands and letting an investment mature. So how does one cultivate this patience? Education is the first step. Reading Graham's The Intelligent Investor or Security Analysis isn't just about learning technical concepts. It's about absorbing a philosophy, a worldview that emphasises rationality over emotion. The more sense the approach makes to you, the easier it becomes to stick with during difficult times. When you truly understand that markets are often irrational, that prices swing wildly while value is steadier, you begin to feel less compelled to act on every fluctuation. Another strategy is to put structures in place that make patience easier. Just as the children in the marshmallow test distracted themselves with songs or toys, investors can use tools like automatic investments, long-term holding accounts, or simple rules like checking their portfolio only once a quarter. These strategies all reduce the temptation to meddle. And then there's the mindset shift. Rather than seeing patience as a deprivation, the pain of not eating the marshmallow, it can be reframed as empowerment. You're not missing out, you're deliberately choosing the better outcome. You are the one in control. Benjamin Graham emphasised temperament over intelligence. He argued that successful investing is less about being brilliant and more about being disciplined. In other words, the ability to do nothing when others are panicking is a superpower. Think of it like this. The market is constantly placing marshmallows in front of you. A hot stock tip, a sudden rally, a headline screaming, opportunity of a lifetime. But more often than not, the smart move is to leave that marshmallow alone. True wealth comes to those who can endure the wait. So what can we take from all this? The marshmallow test may not perfectly predict life outcomes, but it does give us a vivid picture of the human struggle with delayed gratification. As investors, we face that same struggle daily. Most of the world fails the adult version of the marshmallow test, whether it's with cars, gadgets or trading fads. But those who succeed, those who can truly wait, are the ones who build lasting wealth. Patience may not come naturally to everyone, but it can be learned, practiced and strengthened. Through education, self-awareness and discipline, we can each train ourselves to sit quietly, resist the urge for instant gratification, and allow compounding to work its magic. And that is, at its core, what Benjamin Graham was trying to teach us. On that note, I'll draw today's episode of Intelligent Investment Today to a close. I do hope you've enjoyed this discussion about the marshmallow test and how its lessons apply to investing. If you have enjoyed it, please do consider subscribing or adding us to your playlist. That way you'll be alerted as soon as any new episodes land on your platform. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.